please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But right now, let's shift focus to macros, and that's where the headlines are really coming in from. You're also seeing some of the commentary from the RBI annual report. The currency is a big talking point, as we've been discussing. Moody's has come out with a report titled Oil Prices and Interest Rates Raise Pressure on India's Fiscal and Current Account. To discuss exactly what this report is saying, we have with us Joy Rankothge, Vice President at Moody's Investor Service. Joy, thanks so much for joining in. I was looking at the note and I'm just trying to understand what the one-line sort of takeaway is, because while, yes, you are flagging off the concern on the fiscal side with oil prices rising, the report also highlights a lot of positives like the large foreign exchange reserves, the fact that growth seems to be still on track at around 7.5%, the large domestic funding base. So that seems to give the suggestion that there is no imminent threat to the sovereign rating or to the overall fiscal profile of India. So what essentially is the one-line takeaway right now on the fisc from Moody's perspective?
Yeah, thanks for having me. So I think what we're saying is that the risks have increased on the fiscal side, including because of high oil prices, and this is, we think, it's a short-term case. However, as you mentioned, India's growth is expected to be robust, which will help with debt affordability. And as you mentioned, debt affordability will be supported by the large reliance on the domestic funding, as well as India's debt profile. The average debt is about 10 years, and that should also provide some support for debt affordability.
Mm-hmm. As we speak, Joy, good morning, Prashant here. We got the currency at a new low. Does that worry you? And how does that alter numbers on your Excel sheet when you look at things like fiscal deficit, current account deficit, etc.?
Mm-hmm. So as I mentioned, the fiscal deficit, we think that the pressures are, the risks are rising, that the government, of the government meeting its fiscal objectives this year. But again, I think it's a near-term factor. On moving to the current account, we do see the current account under pressure because of yes, oil prices, but also a strong growth which is driving imports into the economy. So we expect the current account to register around a 2.5% deficit this year, 2.5% of GDP for this year. However, from an external vulnerability standpoint, we look at external vulnerability from looking at the foreign exchange reserves versus the debt obligations that the sovereign has. That the economy has, and we analyze that the risks are low for India compared both to similar rated peers, but also the emerging markets.
That's the current account risk that you're talking about, Joy. That you feel, despite the projections seem to indicate that we might be 3% of GDP this year, despite that, you're saying that the current account fear right now is maybe a little lower, the risk is a little lower than some of India's peers?
So what we're saying is that we look at currencies, we look at currency fluctuations more from a credit standpoint and the implications of a currency devaluation on the debt. And if the debt, external debt, dollar-denominated debt will be debt will get revalued, and that will have a negative impact on debt affordability. In India's case, most of the government debt is in rupee and domestically held. Only about 4% of government debt is in foreign currency. And furthermore, the average debt maturity is about 10 years. So these near-term fluctuations on the currency, and because of its in local currency, is unlikely to have a significant impact on debt affordability. Moreover, I think what I was trying to say earlier was that on the current account, from a currency standpoint, that external vulnerabilities, as we measure it, are relatively low for India because of the near record foreign exchange reserves that India has.
We're just getting statements from the RBI annual report as well, Joy. They are talking about the combined deficit, center plus states put together, should be, just under 6%, maybe, 5.6 if I saw that flash correctly, versus in excess of 6% last year. How do you look at sort of the, the concept of rising rates at this point? Because again, as the RBI annual report highlights, that there could be certain upside risks to inflation. You mentioned oil yourself. What are you sort of building in terms of projections, in terms of monetary policy in India? And then therefore, could that raise any kind of, a risk to the overall profile?
So at this point, our base case assumption is that interest rates will rise gradually through 2019, and the impact and that inflation expectations have been the recent rate hikes have helped manage inflation expectations, and overall that. The robust growth profile will help debt affordability on the debt affordability side, and on the deficit side, that that inflation expectations will not have a significant impact on that.
Joy, I appreciate you joining in. Good speaking with you on the program. Thanks very much for coming on board today. Okay, 3-point change on the Nifty, 11,735 is where we are at. We take a very quick break, the first on the show. We come back and focus on what's happening to oil prices. I mean, so the big concern for